Is that better? Is that better? Okay, let me try one more thing. Okay. Let me try one more thing. Does it turn back on? What it is getting feedback. I have no idea what it is. I'm sitting on the beach right now. Check. We good? We good? Okay. It did that wheelie thing. Wheelie, like it did last time. Is that what it was doing? It's some kind of feedback. I don't know. There's like a microphone on this damn side screen that I use. All right, everybody, let's get ready to go. Good morning. Don't forget CPI week. Crazy looking candle on Friday, right? That looks weird. A lot of people are stepping out of the woodwork and calling bearish this week. I don't know. I don't look at candles. You know what I'm saying? We do look at monthly maps and look at what the monthly map came up on Friday. So I'm on my laptop. Sorry about the poor audio quality. But yeah, people are like, this looks like definitely a bearish candle. This is an expiration thing. As you see, we still have bull side strengthening, but there is some volatility coming in about a week or two. And then it gets fuzzy after that. The bull side is still strong-ish, but it's starting to lose a little bit of steam here. You guys remember we lost our first safety net? You hear me with the strong? There shouldn't be any echo whatsoever. Check. You're not listening to me in two different places. Just double checking here. We had the jolts tick up. Tick down, but overall it's ticking up from the bottom, which is decent for what we want to see in the economic side of things. The growth, new job openings is good for ending the recession. Commitment of traders, obviously, we do have selling coming out, covering coming in. So the bull seam has stopped a little bit. There's a little bit of profit taking here, but still liquid enough. Remember, the first safety net's gone. Dealers are negative.
Stocks, options, anything like those ways.
So.
Good morning, everyone. Yeah, actually, I'm watching quite a bit.
So we'll be very close to our futures. We just got our last approval with our team. So basically what we do is we're doing testing on each of the pieces that we need. The final piece has been approved. I approved that. I got an approval. I went through the last approval with them. Let's cover all the pieces. So futures is done. It's ready to go. I put the gray zones in your chart. You click monthly map right here, buddy. Rob. Right up here, monthly map. Click daily map. You want the boxes, make sure you go to indicators and add liquidity maps. Yeah, the monthly map's just a little bit of volatility. And if you guys remember, the VIX is also showing the same thing. Go right here. Look, opening, rational inside the bands. Things look good. 2 minutes for reopen. Above triple B, which means pivots are going to overshoot. Market's going to be slightly more volatile than expected. This is not the best sign for a bull month. So obviously this is going to be a choppier month than expected, as you see the volatility starting to bake into the monthly map. So this guy pushing higher is just a little bit of a concern. We did touch lower DD band, didn't we, on DD? Okay, so we're already going to... No, we missed it by a tick. Okay. Hold on. Hey guys, good morning. Just wanted to throw in my little take about what's going on economically. So I know everybody's talking about CPI this week. In general, some of the signs of the recession kind of coming towards an end have been in front of our faces. Jobs, the jolts have kind of bottomed out and started to kind of pivot up a little bit. Unemployment's looking a little bit better. GDP growth is positive. So all the signs that the recession is actually healing from what's going on in the markets and the economy is actually there. I made a post a couple weeks back says recession was over. Doesn't mean that we're not going to have a volatile week or two. Signs in Rocket Scooter are showing volatility coming back to the table. So we're going to be very careful this week. Obviously, leading a CPI is going to be one of the bigger things people want to see. And now that markets are open, I'll give a little play on what I think I'm going to do in about a minute or so.
Did you ask me here right at market open?
Give me a minute. No, I'm good.
No, you're fine. I was just muting myself. Took some Tesla calls here at the open. I was between 5 and 5:20.
say overall in general, I am looking for bull plays still. Everything across the board is still coming out bullish, just with volatility. Not really coming out bearish just yet. So I'm still just looking for dips to buy or sitting out on big sell-offs like on Friday. So that's basically what I'm looking at.
Were those Tesla 280s that you took exclusive?
Yes. We saw a really big wig pre-market towards 280 plus. So I'm just looking at, we got some good volume for confirmation over an SR level.
All right, we get a bear short up on SPY. Let's see where we're trading right here. As long as resilience is positive, trading through the box up to the top, decent. Ending up at the blue side, 439 is resistance. That doesn't look too terribly bad.
Yeah, nice move coming here for Meta. If any others are taking anything, feel free to call that out. Going to keep the floor open here.
Limited upside though to 439.
No, I'm waiting for the options IV and stuff like that to settle. Taking a trip down here a bit, of course, coming in CPI. So
Bear short up still. QQQ same side, limited 367. I take a break if it pushes through, but really nothing coming through on that as well. Resilience is looking solid, steady. BSU open here. IWM has a little bit more room to move, but it looks like we are hitting up on those resistances there.
All comes running.
So really limited upside. I don't think there's really room to take anything long just yet. Everybody smash that like button while you're here really quick.
Looks pretty good still at the highs of the year pretty much.
Things are looking good on the opening print. We're coming out with basically, bull side positioning, but short side hedging. So a lot of the indices are going to have, I think, limitations in some rough spots today. IWM is the cleanest looking one, about 185.5 upside target, and SPY is kind of bumping into it. So I don't really see that today as being a big up day in general, unless we break through some key levels. 439 on SPY is rock solid hedge pressure resistance. So if it breaks through, it can create a squeeze. And there's really, but other than that, 439 is likely to just be resistance today. But if we do break through, like we're trying to do right now, I'm going to take a little bit of a long just across the board and long things. Resiliences look great. The DD number came in very weak today, so I want everybody to be cautious on that. That's our rocket skier has been showing bull market every day this year. And when that number's below 50, it's not. And it's the lowest it's been all probably for the last quarter. So 58, 59. It's right on the edge of going back to being bearish, so just be careful today.
I'm taking a Airbnb 135 call July 14th.
You guys see that? DD's dropping down to 58.
I was just saying I was taking a trip with Qualcomm.
We are breaking hedge to the upside. DD's bullish enough to get up to here. Resiliences are still strong, still positive, still long. Still looking good. If we do have a fourth, okay, so I'm going to look at today. I'm just going to keep my eyes on SPY today because that's really all that I need to look at. Everything else is pretty much in a similar boat. QQQ hedge pressure touch, still in bear zone. So QQQ can have a squeeze from here. Today's guided move, 20 points on QQQ, could probably pull SPY up into tap the bull zone tap. Now, obviously, the high today is bull zone. Okay, how's the internet doing here? Pretty okay. I can pick up a support bounce on hedge pressure.
Yeah, it's a swing for us. I expect that to do really well.
Yeah.
420 puts NVIDIA.
Alright. Remember, mean reversion in the middle is random. If you look on our cheat sheets, you guys know how this works. So here's a long, small long with some micros right here on 439. So I'm looking at cheat sheet.
Watching that IWM, I kind of missed it there too. I was going to go along the R2Y and I didn't get in. I'm traveling right now, so I'm much more cautious when I'm not in front of my big screens. But yeah, I'm in that IONQ as a long position. I don't have options, and I have options on Rivian at the tool.
I'm popping the cheat sheet real quick.
Yeah. I said I rolled my Rivian.
Got
out and up.
So you know how that works, right? Open on bear side. Oh, that's sorry, it's bearish ratio. I'm
I'm
gonna
a
get the other
little
one.
cautious right now with it.
Evan, what's standing at? Oh,
Keep an eye on that Fortinet. We got some swings that were down 60% that are now back in profit. So Netflix is ripping.
I took a long in S&P futures right off the hedge pressure break. It's limited upside about 10-point squeeze move. I'm looking just for scalping, but not any breakouts today. But I am long. Okay, looking at this. Okay, DD ratio bullish. Everybody see that? Still bullish, still okay. Opening in bear zone. Bull zone tap is what I'm looking for at the most. Back to bear zone. So somewhere in here to there would be what I'm looking for. Everybody see that? Pretty solid setup. Nothing too crazy. Can y'all hear me?
Evan,
Everyone smash that like button really quick. I'm getting up. I'm sitting here staring at the beach on my trip. Loving it.
Yeah, I'm not really
hanging out with you guys.
pulling trigger on anything this morning. I mean, I'm appreciating the DraftKings move. That's a big run right now going on there. Natty Gas. I mean, I'm watching that. That thing always kind of cuts me up, it seems. But natural gas getting a little perky there, maybe swing trading side. But yeah, not too much else on the short term. Kind of let things settle in here.
Can y'all hear me? We good? Okay. Everybody, hit that like button on that stream. You know what to do.
There's 20% on Netflix.
Yes, sir.
Airbnb.
Surf's pretty good. For, you know, it's not some of the breaks are really good. 2 days ago, yesterday was a little calm. We get up at 5 o'clock in the morning, hitting the beach, a couple hours, come back right at sunup, a little bit after. Oh, it's been great. You hear all the birds? We went out to, we're at Carolina Beach. At our family has a beach house out here on the East Coast. It's right now. Oh, dude, living it up. So we have like a little kind of family reunion event coming out here. Everyone flew out, and we spent a week earlier last week. We spent a week in Dallas with Nicole's family, and went to a concert, the Millennium concert, and then we went home for a day, put the cats up with the sitter, and then immediately got a plane and headed out to Carolina. So we're basically Carolina Beach is south of Wilmington. Oh, nice, Chase, dude, it's great. I love it. So I'm longing to bull zone tap as long as ZD stays strong. It's pretty cool. I mean, I would trim probably halfway through. Obviously, mean reversion presses and finds volume in the middle. It'd be very obvious to see if this doesn't work out because you're going to lose hedge pressure pretty quick. So if you lose 439, then that's a loss. Charlotte, yeah, Charlotte's pretty cool too. No. So watching all the signs here today.
Right now, S&P 500.
I love how liquidity map switches to show where you are.
Here on the day, Tesla slightly down, Apple down about 0.7%.
Millennium is sick. Oh yeah,
Leading the way.
Millennium show is really dope. Everybody, make sure, if you didn't know that lifetime deal that we had going on, the platform prices are about to go up. I'm just letting everybody know this. Everybody know this. When we get futures trading and we get equities trading and all these things on the platform, the prices are going to go up. 3,000 lifetime. Get ready for it to be 5,000 by the end of the summer. We're no longer selling an easy $3,000 entry, and we're doing $500 off of that for this 4th of July deal, so $2,500 forever. Monthly prices are going up. For Pro Plus, you'll have to buy Pro Plus to get trading. Everything else that you see right here is the final iteration of Pro. The new release is going to be for Pro Plus only. Futures trading, automatic connect to Discord. Actually, that's going to be Pro. Automatic connect to brokers, all that's Pro Plus. DD bands, red lines, yellow lines, catalysts, the new alerts, vendor tools, all of these extra things coming out are all going to be Pro Plus. Not all of this is going to be available in the trial. So Pro is the trial, and you're just going to get this. So when Pro Plus comes out, if you don't have that, you're not going to get DD bands and futures. And right now, there's a deal going on for Pro Plus. It's all to do like a 4th of July thing. So if you're not in Pro Plus today or tomorrow when we release the future stuff, you're going to be scrambling to try to get it. It's not going to be on your platform, and you won't see it. People are going to say, how do you get it? You have to upgrade. So upgrade today while you can. If you're in the trial, be like, how do I upgrade? I'll give you a coupon for very cheap. Comes in at under $100 a month. The Pro Plus monthly is going to be going up to $300 a month. And so those of you who are in the crew are going to lock in whatever deal that you get, less than $100 forever, is a founder's fee, or founder's rate. So don't want me to miss that message, because we are checking off and releasing futures this week. The plan was to do it tonight. Yeah, we have deals and specials, and as you are a member longer, the deals get less cool. So we want to make sure everybody, is supporting the platform, but we have to pay for the extra stuff, the extra connections, the extra work, extra data, all that stuff. So equities trading and options trading clearly are going to have an options ladder, and that's going to raise the price tier of our data packages, so everyone's going to have to pay for it unless you're already in. If you want to do the lifetime, it's only going to be $2,500 plus tax. Today, and yesterday was the last day, but today is the last day you're talking to me, so I'll say today at midnight we'll cut it. Message me if you need the coupon for that, or it's in the announcement. You can't afford a Pro Plus membership need more time than summer to see if Rockstar even works. Why are you trading if you can't afford a $100 a month thing? I'm not making fun of you, but are you just paper trading, practice trading, or are you actually trying to trade? I always ask that question because when you're trading, you should be prepared to pay for things that are doing any kind of job, right? It's not like you would play a bassoon if you can't afford to buy the fucking reeds. Alright, we're losing hedge pressure. Yeah, we got 10 o'clock news coming out. Let's take a look. You know what I mean? Like, if you're going to take up a craft or a hobby, there's going to be an upkeep cost no matter what you do. Trading, you need it. You're going to go to school for it. Be a chef, you're going to have to buy all kind of kitchen tools and gadgets, So I always found it weird that when I was a new trader, there was nothing available to teach. Nothing. There was garbage books, barely anything. So my question. Okay, actually looking at see for everything. So we're losing hedge, not getting a good break. DD's a little weak. Nah. Resilience is positive, so the box is going to be support, hopefully, which I like to see. My question is that, whenever I was trying to learn to trade, I would have wished there was something for $50 a month or $100 a month, or at least I can just talk to someone as a trader and give me some kind of guidance. We had nothing in the early 2000s. We had books. They were all completely garbage. They're all technical analysis. They're all written in the 80s, 70s, 90s. But my gym membership literally cost me $240 a month. So why would you pick up a hobby like trading if $80, $90, whatever, was a steep expense? Because trading should be where you are able to play with money you have to waste while you're learning. Are we in a recession? if I'm profitable, be able to lash on softwares that I'm not sure even right. It's a great way to think about it. But it's kind of like saying, I'm not going to buy this guitar until I'm amazing at guitar, because I don't want to pay for the guitar to practice playing the guitar on. It makes zero sense. I get your priorities fucking straight. I love you, but that's just that's the stupidest thing I've ever heard. Don't put the cart before the horse. I have to tell everybody that. I say that in love. I love you to death, I promise. I'm not going to buy my chef's knives until I'm a master chef. Therefore, I'm not going to practice along the way. I'm just going to hope I master this thing to be able to pay the upkeep on sharpening my knives every week. So, yeah, that's what I'm saying. You can trade without Rocketeer. Well, that makes different sense, right? You can trade, yeah, and that's a whole different story. Yeah, tell me that beforehand. If you're trying to learn how to do anything, there's always an upkeep cost. But the way that I see it is that you try something, right? You play with it, practice it. If it doesn't work, then okay. That's different than saying you can't afford it or whatever, right? When you say you can't afford something, I was trying to say, like, most people in trading justify this following statement. They go, they're willing to lose 50 grand to YOLO trading before they even put $50 into some kind of shitty service to learn something. It's like a human thing. Humans tend to not have a good gauge on what risk is in their lives. There's a study that was done. So essentially the value added to what's considered risk. People are willing to waste money dumbly gambling. Like, if there was a pro poker player that's like, for $5, I'll teach you how to play poker. You have to sit with me for 4 hours before you go in. You're going to walk right by him and walk right to the poker table and start betting hundreds of dollars each hand. Most people will do that. Yeah, I think it's a wren. There's a lot of birds flying around me. It's beautiful. There's like nature's just got here. There's still okay here. Resilience still being positive. I'm looking for this to bounce. So the study was this, right? They were watching an intersection. And the intersection, basically, there was like a distance away from the intersection where people got hit by a car a lot. Like, people would jaywalk and get hit by a car. And the intersection was deemed safe. And so somebody set up something to monitor people, either A, like if you were walking 50 feet from the intersection and jaywalk, the odds of you getting hit by a car and killed went up hundreds of fold. The probability was practically zero if you crossed at the intersection while it told you to cross. So that human beings would literally increase the risk of death hundreds of fold to save like 13 seconds of time to get somewhere, which really just showed the stupidity of the human brain when it comes to gauging what risk and value actually is. You don't value your life for a measly 13 seconds. And that's why people who go in to want to learn trading will go in and start just, let me listen to this guy because it's free, and this other guy charges $20. I don't know if I want to pay that. And let me start betting thousands of dollars. You're a fucking moron. Just like the person that jaywalks to get hit by a car. That's what I tell people. Like, the idiocy of like not valuing risk is what's going to make you lose as a trader. Everything you do has to value the risk aspect of things. And to me, anything that's moderately priced, like $20, $50, is at least worth like glancing at just to see if it doesn't work. Like, if something costs thousands of dollars, I'd say, okay, let me vet it for 3-4 months, see if I really like it. If something's like, hey, I'll show you everything I know, $30, jump in, learn it all, take it for a grain of salt, say this guy's probably full of shit, but let me give it a shot with $30, right? I've got hundreds of thousands of dollars on the line. Let me just learn from everyone who's touched this trading thing and see if they got anything to show me. That's the way I see it, right? So my thoughts, and I always teach, as a teacher, I have to teach people this. I could sit here all day long and tell you Rocksteer is the best thing in the world, but legally I can't do that. I know what we made is awesome, but my thought is to shape you guys as traders, so you think outside the box about what your value of the risk is, right? And I'll tell you, if something costs more than $100, I might say, okay, let me think about it. If you're a working adult with money to burn, trading's something that might be palatable to you. If you're on the fence about something like $50 or $100 is too expensive, trading is too expensive. And when you said that, I was like, typically people want to do like trader funding programs and make their way to a quick buck and then buy something to support that and go. The proper approach is that that's not going to, nobody accidentally funds themselves with hundreds of thousands of dollars. If you're one of the lucky few that gets a windfall, you're going to lose it, just like 67% lottery winners lose all their money too. If you don't handle it well on the long run, you're gonna gamble. There's that saying in in Wolf of Wall Street, where Matthew McConaughey and Leo are sitting there, and Leo's like, yeah, isn't it great to make money for your clients and us make money too? And Matthew McConaughey's like, no, that's not the point of the game. The point of the game is to put your clients' money into our pockets. Yeah, but if you can make them some cash too, wouldn't it be the same? He's like, you don't make them any cash. It's like you make them filthy rich on paper, but then their mouth is watering and they want that next big trade, and they're going to listen to you every time, and we take home the commission. So it's like people just get addicted to it, and they just keep spinning the wheel. So I always say this: if something is so essentially, nobody accidentally is going to make it. You have to pay for some kind of tuition, some kind of education, because it's widely available. And the difference now than it was in 2010 when I started is in 2010 there was just an abundance of garbage, and it was at the bookstore. Now there's an abundance of garbage, and it's online and on Twitter and on Instagram. The best part is that most of it's free garbage. But walking to a bookstore and thumbing through the books to see if you want to buy it is also free garbage. You don't have to pay for it, and you can read at the bookstore. So the idea is that if you want to try something out to see if it works for you, you're going to need more than a month. Because you have to experience up markets, down markets, sideways markets, sit out days, a little bit of everything. What really you should do is in Rocket Scooter, focus on one tool that you like as an addition to your tool set. Great example. Resilience and DD are by far two of the best tools in trading in general. These are revolutionary indicators because they're arbitrage indicators. Very few things out there are arbitrage. So look at the discrepancy between an index and the basket of stuff it's tracking. So the idea that you have two tools to add to whatever you already do is how you vet value. It's like, okay, I bought a hammer, I can hammer these boards together, but there's this thing there's a hole and I gotta stick this metal thing in there and it's got a cross shape on it, and the hammer's not gonna do that. Oh, I should probably buy a screwdriver in case I need that every once in a while. Okay. So like these two things alone are a screwdriver, easily worth $100 a month. This indicator and that indicator already could be that price. Everything else just consider bonus. If you like it, don't like it, don't like it. But as far as risk management tools, the way I look at things when I buy, will something allow me to make overall better choices? Like I have a strategy. I have A, B, C, D indicators, and if DD is positive, then I strike. If DD is not positive, I don't, as an example, right? Just giving you an example. And if I see that special tool makes my win rate go slightly higher over a history of time, then I give it value. And then I say, okay, that's valuable. If you try to look at all the stuff here at once, it's easy to get lost, and you have to commit a lot more time to assign that value. So in general, pick one thing to see if you like it, and then say, is that one thing in this entire toolbox? So we're selling a whole toolbox full of stuff. Right? If just one of the tools is great, and I always tell people, where do you start? DD's great. Resilience is great. Liquidity map takes some time to get used to. It's a whole different style. But in general, just, resilience being positive tells me this guy's support. Okay, good. DD being bullish means a very good chance that we pop up and touch that before we come back down. Okay, cool. So if I had other bull signals, these things show that there's possible support here and upside to there. Okay, cool. I got two layers of confluence to a trade, blah, 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 and now let's see if that works. And let's give you an example. And if it works, then I can say, okay, Without it, I wouldn't have made the trade, or with it, I made the trade, and if I made a bunch of trades with it, my win rate went down. Okay, then it's not worth it to me. So you have to set up a proper test to see if the value of something's there, instead of just, let me see if I'm making more money using this thing, because making more money is something that takes years to accomplish. And you're not going to wait a year, try something else, wait a year, try something else. You're not going to have time to do that. So to quickly amp up and get up to par with where you want to be in trading, you have to just add one little tool at a time. See if it's affecting your choice making, trading. Anytime something makes you trade less is always a good thing. Anytime something increases a win rate is always a good thing. Anytime something reduces the amount of choices you have to enter at, always a good thing too. That's the way I picture good things. So when I'm shopping for good things, that's what I want to see. Things that make me more selective in my trading. Or something that enhances an existing signal with another layer that I wasn't looking at. That's the way I see it, right? DIA for Harold for YM. Okay, hold on. Working through the Discord tutorials with a question with word risk, so it teaches to have stop one strike distance. The rule of thumb, Chase, is if you don't have, your stop is always your next resistance below. If you need a rule of thumb, your maximum stop should never be more than one strike away from your entry point. So an example, 439, if I bought at 439, my maximum stop should be no lower than 438. We teach the one strike rule. Because if you're bouncing at 439 and it's volatile, remember, Triple B states that you're going to have overshoots and choppy, right? Remember the Triple B rule in VIX? Overshooting pivots and not clean Bs, just basically junky, choppy market. Okay, we know that. So I know that, all right, my maximum stop, if I know that we're just dancing at 439, how do I know 439 is broken and it's not just noise? Well, in the worst possible scenario, that makes 438 that target. Because if we're chopping at 438, then that's the strike of interest, and 439 is a distant memory. You guys got that? So one strike is the maximum stop you should ever have when it comes to trading with liquidity maps. Now, if you have another stop that you use with something else, then it always supersedes the shorter stop is the best. Now, in reality, my stop is always the first support or resistance, and my target's always the next support and resistance. So today, clearly my stop would be below the redistribution zone if resilience goes negative. Do you see that? And that's less than one strike. So I'm being more conservative here. Actually added to my long right here to get a reward to there. So I get my reward is possibly to there, and I need a hedge break to get there. So it's a rare trade with the stop clearly down inside of here if we lose. Do you follow? Hopefully that answers your question. So one strike is your biggest stop, or a rule of thumb if you have nothing else. You set your stop to make sure, and if you have any way you do it, you set your stop to make sure that your trade is at least greater than 1-to-1. So you can arbitrarily set a stop as well. So if you only have 6 points to move, then you might want to set your stop at 3 points, or 6. You know what I'm saying? So the order of stops is the furthest you have is one strike. The appropriate thing is next resistance. And if your distance is 1 and your stop happens to be 1 by those two rules, then don't trade 1-to-1. Pull your stop up a little bit to make it more than 1-to-1. You force it more than 1-to-1. You follow that, Chase? Okay, hold on. Let me answer a couple more questions. You said you take the first deal, you lock in the price for good, so you got the yearly. Yep, you're in forever, man. Adrian, you'll have the best price ever. You want to upgrade to lifetime, you'll have access to the same deal. Yeah, you will. And we'll prorate the remainder of your yearly. Trying to upgrade but having a hard time passing the CAPTCHA, says enable to authenticate. That was your Brave browser shield. Try a different browser, Mike, and if not, send me a message with what you're trying to do, and I'll just tell you how to manually get into it, and I'll walk you through it. 80 is 140 in Australia. Dang. And that's what and again, telling people like the utility of Rocket Scooter. I would say, having DD and resilience is great. It's like it's like a new layer to analysis. Just 2 extra tools to me is worth the entire value, not just like all the education and stuff or how to trade and everything. These 2 tools alone are great. If somebody asks Ariel, but we're in BRSU is likely more that we dump. No, not whatsoever is it likely that we dump. Let's walk through some things. Liquidity map, BRSU, there is no dump case unless you are below monthly hedge pressure or break monthly hedge pressure. It is an upward pressure that hits resistance and likely can fall. If you open between the 2, which we did, it's an upward pressure, Ariel, that likely hits resistance. And it's an upward pressure that likely hits resistance. Now, it can fall to monthly, but liquidity map is superseded by resilience, which is positive, which shows this is also support. So liquidity map, upward pressure, support there, DD's positive. It's likely to kiss the bull side. All 3 things are still, 2.5 things are bullish-ish. There's resistance here, and you saw that resistance there, right? And the smaller chances that we break up, but DD being the highest priority of all the indicators, it's still bullish. If DD was bearish, I might want to short to say we stay in the bear zone. So hedge pressure breaks are, we always talk about the probability of those is very, very low, right? On SPY, it's like an 11% of the time hedge pressure will break. So taking the bet that it's bullish to the upside, okay, it's short-lived because this is not going to be one of those days where it just rallies really hard, because all signs point to what we always say: open bear zone, close in bear zone, open below hedge, close below hedge. So it's likely to be like a shape like that today. But I'm more likely to long because that's bullish. I'm more likely to long because that's bullish. And this is only bearish collapsing if you break through monthly hedge, which is like way down there. So that monthly hedging is still providing positive gamma, and it's still a really strong force, and we don't overlook it. That's why I only short. Everyone, get out your pen and write this down. You're going to learn something today. Spam dumpster, though, on Friday, you guys, I'll show you all the pieces of what you're missing. Friday, the trade was so easy. It already took off and already ended. You can't keep expecting the bounces to take place. Once you hit one support and one resistance, you neutralize, and it's over. If somebody was trying to long mill the day before it dumped on Friday, they're not using any of this correctly. Friday was so easy. Hit the support, hit the resistance, everyone got out. If you miss it, people should just miss it and walk away. I'll walk you through Friday as well. BLU is you hit hedge pressure, you hit resistance, and the day is over. The minute you hit the other side of the arrow, the day is over. The liquidity map is no longer used, right? Because once support and resistance meet each other, once bulls and bears find each other, it's random from here. Anytime bulls and bears find each other and arrows point together, it's random. Anytime support hits a resistance, it's random. Support hits a resistance, it's random. Once bulls and bears find each other, it's the whole point of market makers moving price around. Markets are random every single time. So you only just trade the next resistance and then call it a day. Does that make sense? Hopefully y'all are following. Okay, let me see if I can find something on Friday. I think Jordan posted a picture of it. The trick with rocket scooters, you don't overtrade. We learn to find one support, one resistance, exploit it, and then you're done. I think Jordan posted. Let me see if Jordan posted this thing. So the conversation from this morning is that for people who are saying, I don't know about the price, use DD, use resilience, and then make your decision. You need one particular thing to gauge whether you like this service or not. Just use the rule with DD and use the rule with resilience, and see if that consistency that comes with that is worth the price you pay for it. Jordan made this ridiculously crazy post with 50,000 views. All right, first of all, it opened in a bear short up. Okay, so let's pull up the liquidity map for that. Put them in the same little thing here. So bear short up was actually here, the same thing we have today, and there is no entry point at all inside of here, except for a monthly hedge. Do we all see this? I enter only at the tail of the arrow and exit at the tip. So we open in the middle, just like now. There is no entry point off of liquidity map. There's an entry point off of something else, maybe. But in general, liquidity map, you see the only place is off of monthly hedge. And Friday's analysis, clearly there's no entry point on liquidity map. So another thing is to take consideration. Resilience. Bottom of the box is support if resilience is positive. Resilience is clearly positive today. If you go to your cheat sheet for resilience, pop it up, and these are in the cheat sheets. Opening in the box, resilience is bullish. It tends to break to the upper side of the box. Top of the box is likely to support, or anything below the midline is likely to fade the gap. Okay, here we go. Anything, it's this case right here, resilience is positive, it's going to blast through the top of the box, just like it did, or try to. Okay, Friday's analysis, exactly the same, literally exactly the same setup. This is exactly the same setup as Friday. No different than Friday, literally no different than Friday. We all on the same page? Okay. Trading from bottom of the box to top of the box with resilience being positive is resilience 101. It's literally that right there. Okay. Number 2, breaking through hedge pressure is a very small probability, and normally I only trade to next resistance. And in a sense of, we've already hit a bunch of resistances, trading to box would have been the end of my trade. If you happen to buy for a bigger break, this is all random, which is why we don't trade it. Everyone here properly trading, the way I teach, would have either long from here and closed there, or held a runner and closed to fill the bull zone, because they know the DD rule, DD being positive, is that bear zone will hit the bull zone and come back to bear zone, just like the DD cheat sheet shows. So that Friday couldn't have been any more easy and any more textbook. Everybody I was reading in chat was killing. I wasn't even there Friday. So it's this play right here. Bear zone taps the bull zone, and we expect it to fall back to bear zone. And here's Friday's analysis. I can't believe to some people this isn't worth $100. Like, literally. That's not even confusing. It's there's like a there's like an infographic cheat sheet drawn for fucking 3-year-olds with a crayon to demonstrate in the simplest way possible. Trade from one side of the box to the other. Check. DD, right? Trade from bear zone, tap the bull zone, back to bear. Bear zone, tap the bull zone, and I exit because it's random from there. And that's exactly how that works. You don't expect that thing to happen, but they got squeezed because of expiration. And then it fell back to here. Exactly like it shows it, right? Isn't that crazy? So, here to there. Does everybody see on my screen? Just type yes really quick if you understand that trade. I'm about to hit up the beach. I'm going to exit my long. That was a pretty good trade. Pretty decent. Okay. So anything from here to there is random. The predictable part was here to there, and likely to there to come back to there. Do you even see inside of these first 5 candles? The same exact thing happened. The market moves from here, hits that resistance because it's below hedge pressure. It finds the power to break, hits the top of the band because of resilience. I would probably close my first bit of my trade out. If I held a runner, I would close to there as it returns back to the bear zone. That V actually happened twice. If you traded anything after this, you're basically gambling after the market's found its balance, right? Longing pressure, bulls and bears found each other inside of here, and that's how that works. This was like basically the trade I just made and pocketed out a couple $1,000, and I'm done. I'm about to go to the beach. Anything else here, anything after 2 p.m. we don't trade, right? 2 p.m. is random anyways, and it looks like markets decided to fall towards it anyways. Random things happen every day when you expire. This little break was likely just, look how the volume started to ramp up. This was unusual. You can't predict everything in the stock market, and that's also why we are superior in our analysis techniques. You don't try to predict every single thing. Every single day, this little 10-point move was worth $2,000 for me just now. And it's 10 o'clock Eastern. I'm about to go to the beach and get fucking lit. What happens for the rest of the day, I'm not going to care. I'm going to sit there and I might peek in the Discord and shake my head like, why are everybody overtrading? Why is everybody, what's happening now? What's doing this? You have to learn that less is more. You take the things that make sense and then you just walk away and call it a day. If you're day trading, if you're swing trading, yeah, have a deeper analysis method, sure. Right? We're down in Carolina Beach. We're over in we got a house over in on the beach, south of Wilmington. William said, you believe it all works and nothing works. You have to put in time, you need the experience, you have to learn what works for you. Yeah, exactly. So you have to pick one tool at a time somewhere and just practice playing with one tool instead of going overboard with every tool. To me, DD Band has some strict rules. The DD Band and resilience, and I'm going to tell Slacks, I don't know if you're here, but maybe you should tell people this when they join. The two most important entry tools are DD and then resilience. And so if you want somewhere just to immediately jump in and get started, if DD is bullish, it tells you greater than 5 if rational, check. We're irrational, okay, greater than 6, okay, check. Here's what I expect. Did we open in bull zone? Nope. Did we open in the middle? Nope. Did we open in bear zone? Ah, yeah. Okay. So I got to know by the end of the day, no matter what it does, it's more, 89% of the time it's going to close, or sorry, 96% of the time, this is SPY. With rational non-hedge break markets, 96.6% of the time, you close in the zone you started in. Is the actual back test with SPY. When we did it. We don't do it, and we'll have a thing for you to look at it when we do the backtest module. But that's really what it was. When we first made the indicator, we looked at it. So I expect it to end back up where it started most of the time. I don't bet that it goes from bear side to bullseye and keeps going. Okay? Check. So anything beyond here is a gamble. Whether it goes up a little bit and comes down, or goes up infinity and comes down, or goes up infinity and keeps going, anything that goes bear to bull side break, I don't care what it's doing. I'm not day trading it. Because more often than not, it pulls back down to there. Today it's going to try to do it. Friday it did it. Okay, it's literally the same setup. You see the first time when you touch it, it starts to go there. These are 15-minute candles, apparently. So Jordan's using, this is an hour right here. Imagine longing and then waiting an hour and then waiting 2 hours to go back here. It's already going to be 200 degrees at the beach by the time I wait to break even. Fuck that. I'm going to make my money. Let all the Wall Street losers figure out what else is going here. Should I long, should I short? I don't know. I just got a little richer and I'm going to the beach. That's the way I see it. I take what's easy to see and I let everyone else figure that out. People came through like, this is, I know Jordan has a bearish thesis. I don't necessarily agree, but Jordan's a great friend, and his thesis is based on technical candles, right? That doji type candle. But we all know this is a Friday expiration, right? Holiday week, Friday expiration. Everything after 2 is random. Everything after bull zone is random. It's just random shuffling of positions. In reality, the market still traded up from open to close. It's still slightly better than it was at the beginning of the day, despite the huge squeeze and sell. Nothing about this was alarming at all. Everything about this was scripted from exactly what we expected to happen, wasn't it, right? Here to there, back to bear zone, and support at the open. Okay, let's ask a pop quiz. Why was it supporting at the open? Why was it not crashing below open? See if I can figure that out real quick. Positive resilience, yeah. So you have some really strong supports. Resilience outranks DD, right? Positive resilience, that redistribution zone is going to be really strong. There's your support. There's your support through the box. Hedge pressure pushing down. There's your resistance. There's your resistance. So you have like support, resistance, and it just squeezed a little hard, but the market maker snapped it right back in where buyers and sellers were most common to meet each other. Exactly what you say. That's the real stats, Rob. When markets are just rational, all lights are green, minus hedge break. So we look at only non-hedge break cases. If you open in the bear zone, it closed in the bear zone 96.6% of the time. We did two-month spot tests, one in a sideways market, one in a bull market, and both of them were showing the same thing, which really doesn't, it shouldn't be alarming. I mean, it's a high probability. It doesn't really predict like how the stock market's going to move, right? Because opening in bear zone, close in bear zone can mean a million things. It can mean it completely tanks, it tanks and rallies, it shuffles around and closes there, it just trades flat, it goes up and down, infinity cases. But at least where it ends up is more predictable than how it's traveling, right? So I tell myself, because we open in bear zone, anything here is likely to be short-lived most of the time. So if you happen to be long and you saw this windfall and you go, yeah, I'm finally going to be rich today, and you held through this, you're just a dummy. If I happen to be long and the trade starts breaking the new highs in a bull zone, I probably would be like, holy crap, I don't know how I slept on this and didn't close there. Thank you, universe. Let me close here. Let me get out very quick. It's immeasurable and random beyond here. So what it really just tells you is that Wall Street anchors a lot of money in these positions, and they don't move it around a lot. Bears tend to stay bears even through volatility. Bulls tend to stay bulls even through volatility. The structure is pretty anchored. So if you have billions of dollars shorting something with your hedge fund, you're not out there going to see this and just, oh my God, let me shuffle everything around real quick. You're basically holding for months, if not quarters, maybe years, right? So people are bearing their money in these positions and hanging tight. Hedge pressure break, when rational, excluding hedge pressure break as the irrational signal, hedge pressure only broke by the end of the day 11% of the time. So 89% of the time, if you open below hedge, you ended up below hedge. So what it just says, there's only about 11% or 1 out of 10 days, give or take 1 out of 9 days, that you have enough squeeze that sustains a rally for the whole day. So it basically just says that negative gamma ultimately catches up 8 out of 9 days. So open in bear zone, I always say maybe close. I always anticipate it closing bear zone. And if it doesn't, people say, well, why didn't it? Markets are random, and this you have to understand. You have to know what is random and what's not. Finding supply and demand imbalances is what we exploit at Rocket Seeder. Everything else is just noise, right? So 89%, 96%. As long as these lights are all green, with the exception of hedge break. Hedge break, you can't use that as a metric to breaking hedge, right? So no risk interval breaks on VIX, no outside DD bands, nothing. Just a plain, clean day. Bears stay bears, bulls stay bulls. It just basically means Wall Street is a big fat rock that doesn't budge. We got it? All that means. Oh, Friday tapped the DD band and sold off? Oh, let's check that real quick. Oh, God, and there you go. And your breakout tapped the DD band and sold off. Oh, that's even more textbook. Okay. You actually did have a gauge of where it could possibly go. If you were holding a runner into the bull side, betting on a breakout, and you didn't close when you touched our amazing DD band, which again, you must have been sleeping on that. I didn't even know that. Look what it did. Touch DD band. On the nose. Oh, that's even cooler. All of our stuff played out. So again, I wouldn't be trading any of this, but if you were long on a swing trade, for instance, like day trading. Swing trading is different. If you're swing trading, you want it to break into the bull zone, and you want that 4% chance it goes from bear to bull and breaks out. But if you get a windfall day like this and you hit a DD band, you always exit at a DD band every single time because markets are irrational, or trim whatever you had to 20%. So if I had 10 contracts, I'd be in 2 right there. If I had 100 and I hit that bull zone, then I trimmed to 10. If I held 10 as a runner and I hit there, I trimmed to 2. You guys see that? If you're swing trading, you bought some calls, and the market is just dangling around, and you got your windfall run, you have weekly calls, and your swing trade happens to take off this week, close everything out. Take that windfall. Right? If you're holding this for like a 2-week gain or a 3-week gain. If you get a surprise breakout that's a 4% chance of happening, and it goes all the way to a DD band, and you're holding for like weeks at a time, this is where you take off and get back in the position another day. Close your entire swing out here. You get DD bands through Rocket Scooter Pro Plus. You have to upgrade, and when futures comes out tonight or tomorrow, within probably a week or so, we'll be adding the DD indicator. So you can either get it or you can make it yourself, or you can follow the instructions in the Discord till you gotta make it. So everybody understand that I tell myself on the day trade, it's not supposed to do this, and if it does that, I'm not day trading it. And if I'm swing trading it and I get my windfall, I close out immediately and go away. Check, everybody on the same page? The windfall thing is rare, and I would get out of the way so I wouldn't lose all these days of theta. Imagine you bought some like 44, 46 calls or whatever, and they temporarily went in the money. And you're like, oh, let me hold for the greater one. No, just close everything out and then let the random market take over. If you miss out, miss out. It doesn't matter. You will find another entry, higher probability it does come down, then tell yourself, oh shit, I got a windfall. Let me restructure the same trade tomorrow or the next day off of another support. Imagine you were swinging 500 calls, right? And they went up 100% because you bought them way out of the money. Close everything out, and then today you buy the same calls on the dip because you're not going to hold for breakouts. Even when swing trading, if you get that unlucky breakout that does whatever it's supposed to do and hits a DD band, close everything out and then start over. Are we on the same page? Okay, Mansoor, resilience. Okay, I know that you haven't watched the video of resilience if you're asking a question like that. Resilience is an aggregate indicator. The word aggregate means it's the compilation of a set of things. So resilience is looking at the S&P 500 versus the 500 stocks inside of it. And Q100 is looking at the actual QQQ versus the 100 stocks inside of it. A single stock is not a basket of a bunch of things. You're looking at discrepancies between something that tracks a basket and also trades on its own versus the actual sum of the components of the basket. If SPY is trading faster than the stocks are moving up, resilience is going to indicate that. At certain places, like through this redistribution zone. Ideally, what it says is the stocks are trading faster than the index, and the index is going to catch up. You can't make a resilience for anything that doesn't have at least 2 components inside of it. People are like, can I make an oil resilience? It just tells me you got a lot of videos to catch up on, and those are all in the entries, which is module 2, which means if you bought Rocket Scooter and you're already using it and you didn't make it past module 2 of the 7, I'd spend this week catching up on all the videos and learning what these tools actually do. Yes, sir. No problem, sir. As being an aggregate, everybody make sure you learn what these things actually do. I know it's easy to get used to these things as technical indicators. It's moving up, so markets are moving up. It's not how these things work. Ours are completely different. Resilience doesn't move up when the market's moving up. Case in point, SPY resilience has been moving down for the last hour, and SPY's been moving up. Resilience does not care about the direction of SPY outside of this box. Do we all understand that? Yes, sir, Drew. Yeah, buddy, if you sign up, like I said, sign up, man, and we'll help you immediately. If you sign up, the videos are immediately available in the Discord. There's a module, it's called Boot Camp. You go through modules 1 through 7. 1 through 6 in the trial, 7 if Pro Plus unlocks Module 7, which is like 30 more videos. It's deeper dives into everything. So once you've mastered the trial, just unlock the Pro Plus, and you get all those extra videos dumped, and it walks through a lot more cool stuff, like additional ways to add to it so that you get a little more advanced in your use. Yes, sir. Alexander, you know I love you too, man. Can I look at Meta as a different example? Okay. Now remember, Meta's the one ticker that's perpetually fucked up. Meta is a ticker. We need to teach people this. Meta, you have to ignore. Our data providers cannot fix what's going on with Meta, and we yell at them literally every 3 months for it. Since the name change in Meta, there was another stock that had a ticker called Meta, and now Facebook owns Meta. Meta is completely wrong on hedge pressures, and we don't know why. Well, I mean, I know why. I told them what's wrong. I don't know why they can't fix it. I literally told them. What they have done on some of their exit data to us is they hard-coded in some values based on the other Meta to calculate certain things. And it's not updating with the new Meta. And I can't tell you what goes into certain Greeks that we look at. We look at certain features of the options landscape and of the Black-Scholes model and other things. There are other things that go into certain Greeks that are not your normal things that you would look at, and those non-standard things need to be programmed or estimated or a model to fix them. And I know for a fact, because I sent them a fucking document that reverse engineered their error, and these motherfuckers said, okay, we'll fix it, and then it never got fixed. So either I was wrong or they just didn't do it. Either way, hedge pressures are coming out a little wonky, but the walls are correct. And so don't ever use. We exclude Meta from all of our calculations related to hedge pressure. So that's one thing to note, which is only monthly resilience. It's not included. So that's the one tiny flaw. Until they fix it, we're making sure it's not skewing the data like it's always bullish, like Meta's always adding bull pressure to the market. So, unfortunately, as an example, yeah, when the name change happened, they did it. And so, if you know anything about the Greeks, there are certain things that go into the Greeks that aren't just price data. I know they had hard-coded values, or that the new Meta instrument's not connected to whatever updates those values for some of those data points we need. So what happens is the ratio or the skew is off. Well, we believe that the error is actually a fixed magnitude error. So if you look at it, if you were to take hedge pressure, for instance, and double it, that's where it really is. That's what we think. But then again, it's a magnitude error. So like essentially, hedge pressure is more likely 230, 235. But it's a magnitude of not just exactly 2. It's 2 and some change. So it's hard to kind of estimate. Yeah, Meta's just there. It makes me want to yell at them again. But see, the positional data is correct because Meta comes out pretty clean on the walls and it matches everything else. For whatever reason. Because hedge pressure looks at completely different stuff than your walls do. Okay. That's the only ticker that's jacked up. And it's just hedge pressure. So to answer your question, Monsieur, inside the box, resilience only pivots the box itself. So you have to get very used to not using our tools as like traditional indicators. An indicator moves up, market's moving up, indicator moving down, market's moving down. Those are weak indicators. Stuff like harmonics, the weakest of all indicators. Elliott waves, the second weakest of all indicators. Moving averages, the third weakest. Anything that looks at the shape of price and says, well, this is the shape of it, therefore it must do that, is the weakest of indicators. It's looking at what the price just did in the past and try to estimate the future based on the shape of it. It literally sounds like the dumbest thing to anybody with a college degree in any kind of math-based anything, to say that the last 10 minutes of history is going to predict the next hour of the day. Makes zero sense whatsoever. We take the stance markets are random, so we exploit exploitable things. In the redistribution zone has to do with the imbalance market makers take between one day's close and the new day's open. In the redistribution zone is when resilience kicks on and has an effect. If you look at all of our tools, and resilience will tell you when it's used. All resilience is doing, and there's a little explanation at the bottom, is an exploit of rebalancing the index when the market makers are redistributing the positions they take during the opening and closing imbalances. The redistribution zone. Resilience can break ties at the half gap, predict gap and go or fades, gap and go or gap fade, or show if the open price of previous day's close is support or resistance, which is support or resistance on the box. It's one of our most useful tools. The index gaps up or down every single day. Gap up or down, doesn't matter. Resilience behaves the same against the box itself as shown above. Resilience only cares about the box. So that guide allows me to see, okay, resilience is only conditional when this box is around. So it's not like I'm going to use this indicator every moment of the day. It's like resilience is going to help me pivot. If I'm at the middle, if I have enough conviction, it's going to the top of the box. If we gap above the box, if I have enough conviction, I'm supporting and longing off the top of the box. If we gap below the box and it's bullish, I'm going to long probably somewhere in here to get to the top. We all understand? Only conditional, and it has everything to do with this box in and out. Remember arrows. I get in I get out at the tail, at the tip, and get in at the tail, wherever it is. So wherever I get in, I'm out. I'm out somewhere, resistance. I'm out here. So these are scalp from here to here, scalp to fill the gap, long to somewhere. And resilience only cares about, that's exactly what it shows, right? So I just gauge it when it's happening. Okay, so today we had the condition of we opened and we pushed right to the middle of the box. I check resilience at that time, it's 55. So the middle breaks to the upside more likely than the downside. Check. Boom to boom. Just that tiny leg right here where my mouse is. Everybody agree? Y'all see that? So if it hits there and I made a quick decision, should I long? Okay, long from here to there. I at least have this pressure, but I would need to get out. Okay, well, it's not that much travel. Let me hold on for the gamble that it breaks through, because the stop is not too far. If it breaks, I'm still good and go there. All right. But maybe it's got hedge pressure in the way. Let me wait and see if it breaks hedge, and then I'm good. Or let me see if it breaks out, hits hedge, and then bounces off of here, where that is support. Even better. And that's the trade Papa Bear just made. I took a little bit of a long here. Started breaking through here. I literally tripled my position. Closed everything right there. It's $2,000. It's going to buy a lot of Classy Azul, because we killed our last 3 bottles last night. I'm still hungover. We were playing this gambling game with my brother and his fiance. Left, right, center. It's like a basic dice game, but we're really high stakes, and we fucking lost. So we owe them the booze bill today. We were like, let's play low stakes, $100 limit, and then my brother was like, man, I want some Louis Trey, and I'm like, don't you even talk to me. I can drop 15 G's on a bottle of liquor for you. He's like, I'm just kidding. So $200 bottle or less was the stakes, and we lost. But anyways, okay. Automating red lines, futures data pain. It's in the milestone plan for closer to September. Red lines, anchor points, yellow lines, and catalysts require a very sophisticated model to use AI to extract anchor points. We are in the process of doing so many other things. That is the very last piece of automating all of Rocket Scooter's tools. It's very complicated, and other things have to come before that. I'm actually doing the code myself on that. I'm actually having to learn new types of new methods and new styles of coding to be able to do that. I'm not good at AI type integration. I'm actually learning, watching videos online to teach myself how to code in a different mindset for this type of application, just to get a head start. Our developers are going to do it, but the logic of how we isolate and find anchor points is not a cut and dry method. It requires, like how you would teach a car to recognize a tree stump, when each one of them is slightly different. It's completely doable. What I'm doing to somebody that programs in that style of programming, it's a very simple model. Because if you're looking at a chair has the same characteristics no matter what. A chair has to have at least 3 legs or more, right? Check. That's easy to see. 3 protrusions that touch the floor or more. A chair has to have a flat surface, or a surface that slopes plus or minus 10 degrees up or down in case it reclines. A chair has to have a back, or maybe doesn't have a back. If it has a back, it increases your sophistication of, it increases your likelihood it's a chair. If it doesn't have a back, it might not be a chair. Less probably. Things like that. The algorithm will get confused sometimes and say, well, you can sit on this. A table looks like a chair, meets all your criteria, but also the table's taller than the average human at the face. Okay, what about a small table, a coffee table? So an algorithm will confuse a coffee table with a chair because you program it to be short. Okay, well, you have to give it enough space that human leg has to be above the space of a human leg. Okay, so a coffee table that's exactly the same height as a chair, an AI algorithm would get confused that it's also a chair. When we say, okay, well, it only has a width of X or greater, and X is the fattest human being, or the fattest red line you'll ever see, or the fastest anchor point, then anything wider than one person, which includes couches, which fall in the same criteria, doesn't be considered a chair. Well, shit. A love seat, a big fat cushy love seat, now falls out of the data set when we need it not to. It's kind of what we're saying, right? You got all the criteria for a chair, but your big plushy lazy boy recliner is just wide enough that the algorithm thinks it's a table. You see how that makes sense? Yeah, so the idea is AI programming is like that. And the idea is that you have to have a probabilistic approach to the probability that your stop sign has a chip in it and only has 7 sides when it's looking for a red. The way AI recognizes a stop sign is typically it's red with a contrast background of a non-red thing. Now, if you have an apple orchard behind a stop sign, you might be able to confuse if that stop sign has a chip in it and only has 7 sides, or it's dented, right? And so you have to program probabilistic error such that the probability of that is practically negligent. That if you see a big sea of red and the stop sign's dented up, chances are it's never going to happen. You can't account for that. So you'll have the error, or you need to find some other way, like the word stop. You have to find the one thing that makes it. So the one thing that would make a lazy boy not be considered a table is that tables don't have plush, squishy, fluffy surfaces on them. Okay, and now you've backed into the solution. So you have to analyze each corner of what isn't and etch away. And that's kind of the way you look at it. It's not like you take a sandbox and you build. It's more like you start with a slab of granite and you carve. You have to teach via AI what isn't a red line. Does that make sense? And that's where it becomes easy. Now, a schmuck like myself, who, like I say, I'm a very good programmer compared to somebody who doesn't program. I say like a scale of 0 to 10, I'm like a 3, maybe a 4, which means when I was 12 years old, I wrote Pac-Man from scratch. Okay, but compared to people that program for a living, they look at me and they're like, "Who's this junior that can't code for shit?" Right? Like, they're like, "Ugh, his code is messy." I'm like, I know, I could scrape it together. You guys make it sophisticated. So I'm actually learning how to do this so that I can communicate with my own team. So you have to basically teach it what isn't a red line. And then what happens is machine learning backs into the solution for you. by finding consistencies in data sets and eliminating the idea that your red stop sign will have a sea of red apples behind it to where it looks like it's all red and it misses the red contrast against the blue or green surface. So the idea is that the machine learning would teach you that the probability of that's relatively zero, but it would still account for that and say, oh, there is one instance where, yeah, there's a stop sign and somebody hit it with a hammer. There's only 6 sides to this thing. And there's a whole bunch of red behind it. It's a red brick building, and the contrast isn't there. You need a contrast of a non-red surface, of a stop sign in nature. Or you say, okay, well, what are conditions that would say that this is that anomaly that's maybe still a stop sign? What other things would be there? And then it can say, well, every time we've noticed this pattern, we've also noticed another pattern. That sea of red behind it goes all the way around from left to right. Therefore, it's probably some apple trees. Okay, well, what makes an apple tree an apple tree? Is there green in the picture? Oh, check. Is there, if you zoom in, is there contour of light against the round apple? Shadow on one side, light on the other? Oh, check. Okay. Clearly, it's a bunch of things rather than one thing that's red. So it's not a giant red surface. Clearly, there's a contrast between these two objects. So you have to kind of like carve away and use machine learning to analyze the anomalies. And that's basically how it works. What isn't a red line? And you start there, and then you come up with a set of rules that machine learning create the rest of the rules. And that's what we have to do to automate catalysts and red lines. But when we do that, like I said, Rocket Scooter is going to break another fucking mold in this environment. In the stock market, it's going to get backhand a 10th time. Because identifying sudden illiquidity surges using AI, anchor points, red lines, catalysts. Imagine automating my trading to the point that even a catalyst I get out on. Algorithm says catalyst active, man. That's an anchor point. Get out. And machine learning etches that probability. Like the more data we have, the better the machine learning will adjust its parameters, the algorithm, to actually understand the conditions. Like, we know what's easiest way to do it, and I'm going to give you guys a hint. Everybody knows when you have an event and it moves a risk interval, you're going to see volume. So one of the rules of what is going to chip away at that granite easily, anytime the market suddenly moves, we can program a schedule, right? To get your data set, program a schedule of all the major stock market events. Check. Every single time the announcement comes out, measure if at a risk interval move, was there a surge of volume? Check. Then you now have a data set that says these conditions, and then we have hundreds of conditions, but these exact conditions made an anchor point. And as long as we have enough of those happen, machine learning will determine mathematically what an anchor point is. We can't legally allow automated trading in Rocket Scooter because of our arrangement with our futures exchanges. The CME group is really iffy about people automating trading and third-party applications. Our current agreement with them is that we are not, you must manually push your button to trade. We can automate everything up to that point. As far as automating alerts, automating whatever, but as far as pushing a button and you walking away to trade, I can't make that for you. I can make that for myself, which I will, but I can't sell it to you. We can make different exchange agreements down the road, but you guys go do your work. If y'all want an automated trading platform, get us to 10,000 members this year, and then we can pay for the ability to do that. They want you to pay a lot of money to get that agreement. And we're a whole different thing at that point. Very few people allow that. NinjaTrader allows that. They pay a very, very hefty penny. Futures are the one group that is very, very, very against automation. You can't automate in Thinkorswim. Even Thinkorswim didn't go through and allow you to program that. It's not because developers don't let you, it's because the exchanges want you to go in there and manually trade. They don't want you to be efficient. They want you to go out there and nickel and dime. The same reason casinos don't want you to go in there and count cards. Automation is efficiency. Efficiency means you trade better and trade less, and they make less money. So if you're going to automate trading, they make me pay more money on your behalf. This is how this business works. Being a developer of a trading platform has exposed me to all the inner workings of this industry. I love teaching you guys the things I learned too. You understand? If you're trading more efficient, you're not paying your dollar every trade by over trading. You're trading less and trading better probably. The exchange is not going to like that. The house is going to like you to walk in counting cards or with the system. I think a casino is selling books at the front of the casino on how to automate your trading style, or on how to automate your poker style, how to get ahead, how to get an edge against the casino. And if they were selling books in a casino, it's going to be how to trade, how to spread your money out better, how to gamble faster, how to get free shit at the casino. They want you to trade more and play more games manually and make more mistakes and give them more of your money. So either way, as a smart business decision, they're going to make their money no matter what they do. So to have an automated trading platform, they know you will trade more efficient and they will make less, so therefore you pay more for the opportunity to do so. And there you go. And we chose to elect, with our agreements, not to allow automation for our users within our platform. So, but I can go build any third-party app I want to automate my own stuff for myself I can write a macro that moves my mouse and clicks a button on my own computer. But we can't allow you guys to do that. It's like part of the experience. Unfortunately, no. It's pretty cool, right? To see how sophisticated we are going. Redline is or all the anchor point stuff. And again, one of the shareholders, one of the major partners of the corporation, only joined the team for that specific purpose. He came armed with a team of AI machine learning programmers, have been waiting for years to jump onto the project to do this portion of it. Rocket Scooter AI is not just a name we threw out there. We're going to use AI to discover rules, and that machine learning to discover rules utilizing AI features. And so, trust me when we say one of these days Rocket Scooter is going to send us a message and say, by the way, we discovered a new alert with 90% probability. And we've been analyzing the data in real time, and all of a sudden we realize under these conditions, here's a trade setup that works all the time. Here's a new rule you didn't even know with your own tools. Rules that we didn't even know existed. That's the whole point. And all it does is take enough data. So ideally, like I said, the way that we're going to carve out the granite is we're going to start looking for a schedule every time CPI comes out. That's on the calendar. So we can measure that. And we know often those move a risk interval. If it moves 31 points or whatever risk interval is, and we see a volume surge, the machine's going to go, okay, that's it. And every time it happens, because the scripted ones are good, then finding the unscripted ones will be easy at that point. Because once you get 10, 20, 30 data points, it's going to start realizing a pattern. What's going on immediately that I know in the first couple of seconds that's consistent each time that led to that 31 point drop. So sometimes, an event or an anchor point doesn't move 31 points exactly. So we'll find out what the algorithm notices in a consistent approach, and it's going to create a rudimentary rule that it's going to have to curve fit and just shape the mathematics each time. And the parameters we tell it to look at are going to be everything. All the conditions of Rocket Scooter, volatility, we got a lot of things we're going to look at. Trust me. And that's why I've been learning how to program with that mindset. The etch away mindset. What if they adjust the algos against Rocket Scooter? Who's they? What, the Illuminati? Is it like a secret society of people that control the stock market that are looking out for third-party platforms like us to take down by adjusting the master algorithm? What if they, hedge funds? All right, imagine this, right? There's no such thing as a they. They is a myth. They is a collection of millions of independently self-acting entities. It's like saying, what if they decide to change hamburger meat to chicken and all the hamburgers around the world at the same point, at the same time? I don't think it's ever going to happen. They don't talk to each other because they are competing against each other. They have no vested interest in helping each other out to risk their own gain. If there is a single entity or two that somehow recognizes we're trading directly against them, which is almost negligible to happen, and they realize there's a pattern, they adjust their algorithm. It's a drop in the bucket compared to the sum of all the theys out there, that the entity is a countless array of stars in the galaxy that are slightly pulled to each other because of gravity, but mostly independently acting on their own fuel source. The greatest way to see it. Ain't no they. Promise you that. Hedge funds, there's no way to adjust anything to counter to anything. What happens if you create a... let me tell you. What happens if you create an antibiotic that kills a bacteria? But one bacteria survives it and is resistant to it, and then creates a whole family of bacteria that now resists that. Well, then you find out what their resistance is, and then you program around that with a new antibiotic, and then you kill all of them until they resist you, and then you resist them, and they resist you, and you resist them, and you create a non-ending space race that completely always is searching to one-up what one-upped you. And believe it or not, that is what happens in Wall Street. It's a constant technology race of people always trying to one-up what the new status quo is. Here's an example. We used to always trade hedge pressure all day long, until we realized that after 2 p.m. on days that the SPY was expiring, Monday, Wednesday, and Friday, we saw enough data points that we saw that the actual behavior was random. See, that's like human, it's not real machine learning, but it's the same process, just using a human like myself. I noticed that every time I traded after 2 p.m., I got random results. And then I started going back and saying, okay, I noticed this pattern. Oh, you know what? Every day at 2 p.m., it is random. And we thought that, could we predict what happens at expiration? And the answer is you really can't. Not yet. We think maybe we can use DD to help probabilistically, but in the end, it's like people are going to do random things based on their exposure to the market during expiration. And they're not going to care about the technicals. They need to get in and out of the position because those options are expiring. That's a stronger force than anything. Okay. And so when now SPY has daily expiring weekly options every single day, Monday through Friday, immediately when they released a new set of options, I released a new rule the day after. Nobody trade after 2 p.m. ever for any stock, anything in the American markets. Or anywhere around the world, because people listen to our markets too, I guess. So 2 p.m. until 4 p.m. Eastern Standard Time, markets are random in general. So they released a new set of options. We release a new rule. They change the margin requirement. We change the risk interval. We always adapt as they adapt. The sum of everybody out there is an individually self-serving acting entity on its own self-interest, is looking out, particularly market makers and exchanges. It's a Nash equilibrium. They need to keep each other floating in a way, but each one of them is competing against each other to make profit. An example, I'm teaming up with some of my competitors who we are stealing food from each other's mouths on the platform side to build a greater thing where we're both winning bigger in the end, as an example. Right? You and your burger, I'm not saying I'm doing that, I'm saying as an example. Like you and your buddy, or this guy, your mortal enemy, has like a hot dog store across the street from your hot dog store. And you guys brutally attacked each other to where the drama made you both lose business. Or you both just hilariously shout insults at each other comically and smile, and the entertaining value of that makes people line up just because they want to hear you go, hey, so-and-so over there's got stinky feet. You know what I'm saying? Like, if you create that. So the idea is that people would be like, oh, this is cute. I'd love to come hang out with both these places. So if you're working with an entity, which they loosely do, the overall goal is for everyone to make money or you to make money. So no one out there is going to be able to detect or understand what's going on and create an algorithm that counters every single automated thing out there that's evolving. Like, millions of people are automating their trading. If there was a they would never reach an equilibrium, or they beat everything. The minute they beat one of the million things that were trading against them, that one thing's already trying to adapt, and the other things are still beating it. They're always constantly trying to adjust and beat things. There's always things trying to adjust to beat them back. So as long as you're evolving, that's fine. Now, hedge funds are not operating on an uber sophisticated level because they don't have data that we don't have. They might have had genius mathematicians, so do we. They may have more faster tools, whatever. They can obviously easily counter what Rocket Scooter does. They buy the platform and say, let's just move the market because these guys in Rocket Scooter do this, but we're a tiny drop in the bucket. If they make us lose more, for whatever reason they could do that, other people would win more. What if somebody bought Rocket Scooter with a hedge fund and decided to short everything we longed with 100 times the money? If they tried to counter Rocket Scooter, then that person who trades against it would win 100 times the money. Then they would have no incentive to counter it. They'd have more incentive to make it stronger. See what I'm saying? So the idea that somebody would scope out one particular thing doesn't make any sense. It's silly. Okay. All right. Anybody have any more questions? It's starting to sprinkle. I need to lock my computers up here. I love you guys. We're going to get out of here. Great day. Easy day. Took a long, double down. Yeah, exited kind of up here. Looked like it was hitting some resistances, and I'm out. Starting to sprinkle. I got to go. Love you guys.